Hey everyone, the Imperial Guide to Finance here to help you with this upcoming tax season. Let's be honest, nobody likes thinking about taxes, but the truth is, they're unavoidable. The good news is, with a little bit of planning and the right strategies, you can actually save a significant amount of money come tax season. That's why, in this video, I'm breaking down 9 essential tax tips specifically for 2025 that could help you keep more of your hard-earned cash. We'll be diving into everything from maximizing retirement contributions to strategically offsetting investment gains. Whether you're already a seasoned investor or just starting to navigate the world of personal finance, these tips will provide valuable insights to help you optimize your tax situation. Remember, every dollar you save on taxes is another dollar you can invest, spend, or put towards your financial goals. So, let's get right into it. Did you know that the federal gift and estate tax exemptions are set to change after 2025? That's right, the clock is ticking. Right now, we're benefiting from historically high exemptions. This means you can gift or bequeath assets without incurring federal taxes. However, starting in 2026, these exemptions will be cut in half. It's crucial to start planning early. Now might be the perfect time to take action. So, what can you do? First and foremost, don't wait until the last minute. Consult with a qualified financial advisor or estate planning attorney to assess your specific situation. They can help you determine if your estate will be impacted by these changes and recommend the best course of action. One strategy you might consider is gifting. Remember, you can currently gift up to $12.92 million during your lifetime without incurring federal gift taxes. You can even make annual exclusion gifts of up to $17,000 per recipient in 2023, and this amount is adjusted for inflation annually. Another option could be setting up a trust. Trusts can be powerful tools for managing and distributing assets, potentially reducing estate taxes and providing for your loved ones according to your wishes. Remember, estate planning isn't just for the wealthy. It's about ensuring your hard-earned assets are protected and distributed according to your wishes. Taking the time to plan now can save your loved ones time, money, and potential headaches in the future. Congratulations if you've had a successful year in the stock market. It's always a great feeling to see your investments grow. But here's the thing, capital gains taxes can take a bite out of your profits if you're not careful. That's where tax loss harvesting comes in. This strategy involves selling investments that have experienced a loss to offset capital gains you've realized from selling winning investments. By offsetting those gains, you reduce your taxable income and potentially lower your tax bill for the year. Now you might be thinking, wait, why would I want to sell investments at a loss? It feels counterintuitive, right? But here's the key. Tax loss harvesting isn't about giving up on those investments altogether. Instead, it's about strategically using those losses to your advantage. By realizing those losses on paper, you can offset gains and reduce your tax liability, freeing up more money to reinvest and potentially come out ahead in the long run. So how do you actually implement tax loss harvesting? Identify investments trading at a loss. Determine your capital gains for the year. Sell losing investments to offset gains. Beware of the wash sale rule. Wait 31 days before repurchasing. Consult a tax professional for guidance. Working from home? Maybe in your pajamas with your dog. That's awesome. But did you know your work location affects your taxes? Different states have different tax rules. Track your work locations to avoid surprises at tax time. Look, I'm not a tax professional, and this isn't financial advice. This stuff can get complicated quickly, especially if you're dealing with multiple states or even international work situations. Seriously, the last thing you want is to get hit with unexpected taxes, penalties, or even legal issues because you weren't aware of the rules. That's why it's crucial to consult with a qualified tax professional, especially if you're a remote worker who's frequently on the move. They can help you navigate the complexities of state tax laws, determine your residency status, and ensure you're filing correctly. Remember, a little bit of planning and professional advice can go a long way in saving you money and avoiding headaches down the road. Don't wait until it's too late. Let's talk about retirement, guys. Yeah, I know it seems far away, but trust me, it sneaks up on you faster than you think. And when it comes to retirement planning, maximizing your tax-advantaged accounts is absolutely crucial. We're talking about accounts like your 401k and your IRA. These accounts are specifically designed to help you save for retirement while also providing some sweet tax benefits. The beauty of these accounts is that your contributions are often tax-deductible, meaning you can lower your taxable income today. That's right, you get a tax break now, and your money grows tax-deferred until retirement. And for 2025, you can contribute up to $23,000 to your 401k and $7,000 to your IRA. Now, I know what you're thinking. Graham, that's a lot of money to be putting away. And you're right, it can seem daunting. But even if you can't contribute the max right now, every little bit helps. Start small and gradually increase your contributions over time. Maybe you get a raise or you get a bonus. Put that extra cash straight into your retirement account. Remember, the earlier you start contributing, the more time your money has to grow. Thanks to the magic of compound interest, even small contributions can add up to a significant amount over time. Seriously, guys, don't sleep on retirement savings. Max out those accounts, take advantage of those tax benefits, and set yourself up for a comfortable and financially secure future. All right, let's dive into the world of Roth IRAs. Now, you might already have a traditional IRA, which is great, but have you ever considered converting it to a Roth IRA? See, both traditional and Roth IRAs are powerful retirement savings tools, but they have key differences in how they're taxed. With a traditional IRA, your contributions might be tax deductible now, which is cool, but then you pay taxes on your withdrawals in retirement. With a Roth IRA, you contribute after-tax dollars. That means you don't get an upfront tax deduction, but here's the kicker. Your withdrawals in retirement are tax-free. So, which one is better? Well, it depends on your individual circumstances and your future tax bracket predictions. Now, converting from a traditional IRA to a Roth IRA isn't always the right move. It really depends on your individual financial situation and your future tax expectations. But if you expect to be in a higher tax bracket in retirement than you are now, a Roth conversion could potentially save you a ton of money in taxes down the road. Think about it. Would you rather pay taxes now while your tax rate might be lower? Or would you rather pay taxes later when you might be in a higher tax bracket? Of course, there are some things to consider before you make a move. You'll need to factor in the tax implications of the conversion itself, as you'll have to pay taxes on the amount you convert. It's always best to consult with a qualified financial advisor to determine if a Roth conversion is the right strategy for you. They can help you weigh the pros and cons and make the most informed decision for your financial future. Let's face it, nobody likes paying more taxes than they have to. That's why I love talking about tax-aware investing strategies. These are ways to potentially lower your tax burden while still growing your wealth. One of my favorite examples is municipal bonds. You see, when you buy a municipal bond, you're essentially lending money to a state or local government. In return, they pay you interest payments, and the best part? These interest payments are often tax-free at the federal level. Think about that for a second. You get to earn interest income without Uncle Sam taking a cut. Now, depending on where you live and the specific bond you invest in, you might also get tax breaks at the state and local level. That's a triple tax advantage you don't want to ignore. Of course, like any investment, it's crucial to do your research and understand the risks involved before diving into municipal bonds. Consider consulting with a financial advisor to see if municipal bonds align with your overall investment strategy and risk tolerance. Municipal bonds are just one example of tax-aware investing. There are other options out there like real estate investment trusts or REITs, which can offer unique tax advantages. The key is to find investments that align with your financial goals and risk tolerance while minimizing your tax liability. Remember, tax laws can be complex and change frequently. That's why it's always a good idea to consult with a qualified financial advisor or tax professional. They can help you navigate the ever-changing world of taxes and create a personalized investment plan that considers your specific circumstances. Don't let taxes eat away at your hard-earned money. By understanding the power of tax-aware investing and seeking professional advice, you can potentially keep more of your money working for you. Remember, building wealth isn't just about how much you earn, it's also about how much you keep after taxes. Let's talk about college costs. College costs are skyrocketing, and it's a major concern for many families. A 529 education savings plan can be a game changer. It's a dedicated savings account for education expenses. Contributions grow tax-free if used for qualified expenses. No capital gains taxes on withdrawals for tuition, room, and board. You can superfund a 529 plan using the gift tax exclusion. Gift up to $17,000 per year per person. Contribute up to 5 years' worth at once. A married couple could contribute $170,000 per beneficiary. It's a great way to save for education and shield money from taxes. Setting up a 529 plan is straightforward. Open one with a state or through a financial advisor. Compare fees and investment options. Anyone can open a 529 plan for a beneficiary. Family and friends can contribute. Remember, unused funds may incur taxes and penalties. You can change the beneficiary or roll over funds to a Roth IRA. A 529 plan is a tax-advantaged way to save for education. It's a powerful tool for managing education costs. Investing in education is investing in the future. All right, let's talk healthcare. We all know healthcare costs can be a huge burden on your finances. But guess what? There are tax-advantaged accounts out there specifically designed to help you tackle those costs while keeping more of your hard-earned money. One of my favorites is the Health Savings Account, or HSA. Now, these are like a secret weapon for people with high-deductible health plans. And the beauty of an HSA is that you're actually contributing pre-tax dollars. That means you're lowering your taxable income right off the bat, which is always a win in my book. But it gets even better. The money you contribute to your HSA grows tax-free, and you can withdraw it tax-free as long as you use it for qualified medical expenses. So it's like a triple threat. Tax savings up front, tax-free growth, and tax-free withdrawals when you need them. If you're eligible for an HSA, I highly recommend checking it out. Now, let's say you don't have a high-deductible health plan. Don't worry, you still have options. That's where flexible spending accounts, or FSAs, come in. FSAs are similar to HSAs in that they allow you to set aside pre-tax dollars for healthcare expenses, which again, lowers your taxable income. The key difference here is that FSAs typically have a use-it-or-lose-it rule. So you'll want to plan carefully and estimate your healthcare expenses for the year to avoid leaving any money behind. However, there's a potential workaround here. Some employers offer an FSA rollover option, which lets you carry over a certain amount of unused funds to the next year. Always check with your employer to see what they offer. Ultimately, both HSAs and FSAs can be valuable tools for managing your healthcare costs and saving on taxes. Listen up, guys, because this next tip is all about planning for the future. You see, back in 2017, the Tax Cuts and Jobs Act made some significant changes to the tax code. But many of those changes are set to expire at the end of 2025. That means we're potentially looking at a whole new ballgame when it comes to taxes in 2026. One of the biggest changes on the horizon is the increase in the top individual tax rate. Right now, it sits at 37%, but in 2026, it's scheduled to jump back up to 39.6%. Now, if you're in a high tax bracket, that's a pretty significant difference. And to make matters even more interesting, the $10,000 cap on state and local tax deductions, or SALT deductions, is also set to disappear. So what does all this mean for you? Well, it means that planning ahead is crucial. If you anticipate being in a higher tax bracket in 2026, there are some strategic moves you can make now to potentially soften the blow. One option is to accelerate income into 2025 while tax rates are still lower. This could involve things like adjusting your billing cycles, taking on additional projects, or even selling appreciated assets to realize those gains at the lower rate. Another strategy is to reevaluate your itemized deductions. With the SALT deduction cap going away in 2026, you might find that itemizing makes more sense for you. The key takeaway here is to start thinking about these changes now and consult with a tax professional to develop a plan that aligns with your specific financial situation. And there you have it. 9 powerful tax tips that could potentially save you a ton of money, not just in 2025, but for years to come. From reviewing your gift and estate plans to maximizing your retirement contributions and even strategically preparing for the 2026 tax changes, these tips are designed to help you navigate tax season and beyond with confidence. Remember, knowledge is power, especially when it comes to your money. So, which tip will you try first? Let me know in the comments below. Don't forget to like this video, subscribe to the channel, and hit the bell icon for more tips to take control of your finances in 2025 and beyond.